A very good afternoon to you all. In the same conference last year, you will remember that I welcomed you to the 10th anniversary of the financial crisis that began with severe liquidity problems in some banks, followed by insolvency and widespread systemic risk. This is precisely what university students are reading today on economic history, along with the oil price shock in the 70s, the Black Monday of 1987, and the emerging market crisis in the 90s. You might agree with me that the financial crisis of 2007 is part of history. Going forward, financial stability, of course, will continue being part of policymaking, but other objectives are also part of this story, and we need to put more attention on certain elements of the risk reduction package that can help the competitive profile of European banks' business. Let's not forget that banks are businesses, not compliance offices, and finance to European businesses. In this respect, I would like to draw your attention to several key decisions that will be made in the next months by European policymakers. There are many of them, but I would like just to highlight 6 key decisions. The first one is about the fundamental review of the trading book. Everything has been said. I can't agree more with the financial attaché from France, what he has said before. I think we have enough regulation, so why should we front-load something that is coming in the next 10 months from Basel? So the Commission rightfully included FRTB in the original proposal in 2016 because it was meant to be implemented in 2019. But now the Basel Committee has aligned FRTB with the general timeline of the finalization of Basel III. Against this background, we have 2 options for the Bulgarian presidency. One would be to continue developing anything on FRTB, no matter if it is hard requirements, reporting, whatever. That only distracts attention. In the EBF mission to the US last month in Washington, we learned from US regulators that nothing will be done in the US. I mean, they made the question, why should we do anything about this? Let's wait 10 months and then we will be committed. So the same should be followed in Europe. That is the only option that makes business sense. It happens to be the one followed in the US and the one that the EBF recommends. A second important decision, and here I would like to raise the attention of how important is in terms of impact in the markets, the treatment of repos in the net stable funding ratio. Because the repo markets play a key role in facilitating the flow of cash and securities around the financial system. A well-functioning repo market supports liquidity and contributes to the efficient allocation of capital, which is a key issue for our financial officers of banks, but also for corporates. Let me show you in that graph from the Basel Committee what is the trend of the EU repo market from 2014. You can see that the percentage of cash placed in repos has declined from more than 40% to less than 20%. And more importantly, the number of active counterparties from an original sample of 11 has been reduced to just 4. The NSFR could compound this negative trend if the asymmetric treatment between repos and reverse repos keeps on threatening market liquidity. So we have 2 plausible options here. One is an improvement already introduced by the rapporteur in his report to allow the netting of repo trades. However, only for transactions which have exactly the same maturity date. So this is a step in the right direction, but we would like to improve this option with a netting structure that can allow netting by buckets of NSFR maturity dates. This would mean less than 6 months, between 6 and 12 months, or more than 12 months. This would really make a difference. The repo market in Europe is essential. It amounts to more than 5 trillion euro. And the effects it might have are absolutely unknown, are uncertain. There is no precedent. Even the Basel Committee in this report is questioning whether there is some systemic risk involved. So this is a point of attention. But also, before going forward, I think the next question is about the European Union. Do we believe in an EU integrated market for financial services? We have talked about this time and again. If your answer is yes, then you should favor that liquidity subgroup status should be granted automatically. And also the preferential treatment to intra-group transactions within the Union should be granted automatically with no supervisory discretion. That's only a burden. After all, the European Banking Union is a single market. We know there are things to do, as the rapporteur has shadow rapporteur has already reminded us, but it's been 5 years with a single rulebook, 4 years with a single supervisor in the euro area. If we don't believe in Europe, who will do? I think this is something that needs to be reflected upon. Then the other question, number 4, I wanted to raise was about Pillar 2 and systemic risk. I am a bit puzzled about the willingness of some member states to impose systemic buffers within the scope of Pillar 2. This is a nuisance. This is, I think, regrettable in my view. If the Commission's original proposal to tackle systemic risk in the right place out of Pillar 2 is not followed, this will only mean simply less credit available in countries that mostly need it. Talking about credit, an issue that the EBF has defended from the beginning is about export credit business. Perhaps it's not a massive business, not one of the major portfolios, but a strategic one for our corporates and SMEs. Here, the Basel Committee allows the national supervisors to set the required stable factor in NSFR for off-balance trade finance-related obligations. And we have been examining what other regulators are doing, and it happens that they have already opted for funding requirements which are significantly lower than the current European proposals, which stand at 15% required factor, right? So I think this needs a careful review. Also, this is not in the interest, in particular, of banks, in the interest of corporates that are using this vehicle for exports. Also, importantly, the exemption to the leverage ratio for export credit guarantees should be extended without credit step conditions to respect the level playing field across member states. And it should be applied in all currencies, because it happens that today, we defend the euro, but today 75% of the export credit business is denominated in US dollars. And question number 6, and my last question. Should the penalization to bank software continue? Banks invest in software development mainly to remain competitive and to invest in strengthening their cybersecurity. Let me underline this. This is the time of cybersecurity. Look at the news, you know what is happening. Banks need to invest in software. At this moment, we can't wait on that. Many MEPs have already been made aware of this, and they have tabled amendments to remove the deduction from capital, because in current legislation, the cost of capital of software is blocking CFOs of banks to invest more in software. This is something critical. Let me show you what happens currently. In some of our conversations with policymakers, one point was understandably made that software might not have value in case of liquidation. But I don't agree with that, because there are 3 tools to resolve a bank: the bail-in, the bridge bank, and the sale of business. In the case of the bail-in and the bridge bank, the main goal is to maintain the critical functions of the bank after resolution without disruption. Software is precisely that, a critical function. You may agree with me that a bank cannot operate without its software. So how come that in current legislation, more value is given to a lifeless stable than to the software of the bank? This is wrong. Up to 12 times more value in terms of cost of capital. This is blocking the modernization of European banks. This is something serious. We need to put it in the agenda. Also, Shadow Rapporteur pointed out that certain deviations from Basel, if they made a lot of sense for the European economy, could be taken on board, I think this is the first. This should be discussed in the Council. As to the sale of business, let me give you a very clear example. Banco Popular was resolved 10 months ago, yet it's still using the same software. Do we need more evidence? Let me summarize. Regulatory efficiency, competitive profile of our European banks, and finance to European businesses. This is the way forward. If these points were taken on board, we would be getting it right. Quod erat demonstrandum. Thank you for your attention.